And thank, and thank you for joining us at a time when I believe markets are not just moving up and down, but I would believe that they're constantly testing our conviction as well. Over the past year, as we move into the new financial year, we have seen equity markets navigate sharp volatility, shifting global cues, and now possibly rising geopolitical tensions as well. But as always, such phases also create opportunities for those who stay informed and obviously well disciplined in their investment approach. And that's exactly why today's session is so relevant. It is our privilege that we have Mr. Manish Sonthalia, who is our CIO at Emkay Investment Managers, who has an experience of more than 3 decades now into equity markets. And I would believe this is this particular experience that will help us decode the current environment and also position ourselves better for what lies ahead. With that, I would say a warm welcome to Yusuf Manish sir, and over to you. You can just take it ahead. So you're on mute.
Sorry. Good evening, folks. Thanks for your time. We are connecting at a time when there's heightened volatility in the markets, and particularly so after February the 28th, when all of a sudden there was an invasion, or there was an attack by Israel on Iran, and the repercussions that have followed. So, in that backdrop, how should we look at these things? How should we look at the historical perspective of what happens in the case of a war and beyond? And what should we be doing? So, we have just created some thought points as to how this whole situation could be navigated into an opportunity and a profitable opportunity going into the next 2 to 3 years. So that's basically the idea of this meeting that we are having virtually. So, just penning down my thoughts as to how we should be looking at a situation where we stand. And this is my base case. I hope you can see the PPT, right, Rahul?
Yes, sir.
Yeah. So this is the base case scenario, right? So, this war has been continuing, and basically, this is the prime agenda which will set the context of where and how the markets would shape up going into the next 9 to 12 months and beyond. So, this is the base case scenario, and there could be a different scenario, and I'll talk about that as well. So, currently, when there is a full-fledged, military conflict that is going on between three nations, how should we look at things? So I think first there will be a period of escalation for the next 2 weeks, because we have been given 2 to 3 weeks by Mr. Donald Trump. And I think the next phase is that next 15 days, you'll see a heightened conflict increase. And this will manifest itself into disruption through shipping that is already playing out. There'll be proxy attacks because, the UAE and the GCC is bearing the brunt of all the strikes by Iran into bases in the US bases in all those geographies. And there will be infrastructure risk, and there will be a risk of retaliation. So the base case scenario is that this is going to be a military reset as opposed to a diplomatic reset. And I'll come to a situation where there could be a diplomatic reset, and we really don't know how things would shape up. But the base case scenario is that the diplomatic reset is not happening and a military reset is happening. One of these, Iran is going to be obliterated because US is a mighty US. And of course, morality and all of that is, one's own perspective, but might is right. So military reset is what is going to play out. So how does this manifest itself into markets on a global basis and even on a local basis? I think markets are going to reprice the facts. And what are the facts? Is that energy, which is oil, LNG, and freight, are already bearing the shock of what we are seeing in the conflict. This is moving from uncertainty to a measurable macroeconomic transmission, translating into growth shocks for some period of time. So how is this going to play out? Is that the energy shock is going to result in a inflationary shock, resulting in a supply chain disruption, manifesting itself into a growth shock, the repercussions of which is going to be felt on a global basis. India is also a part of it, so a part of the damage will also be felt in India. However, the pain is slightly uneven, according to me. Europe faces a stagflation, that is very high inflation, very low growth, and even energy consuming or heavily importing nations in Southeast Asia and South Asia are going to bear the heaviest brunt. And the repair is going to be felt after this transmission has played out over a period of time, which is to say that early 2027, let's say the military conflict was to end in some sort of solution within the next 2 weeks, and there is a toll that has to be paid through the Strait of Hormuz, through which 40% of global oil supplies flow, and all of that. This supply chain disruption, reparation or repair of which is going to take some time, and early 2027 is where we can expect that some degree of normalcy would be happening. So, in that broad construct, basically the repair is not going to be holistic and across, but very selective, is what we think is likely to happen. So, what is the solution in the case of India? The solution in the case of India, according to us, is that we have already seen a lot of pain, and bulk of the negativities broadly is played out through manifestation in the earnings, in the valuations, etc., the currency, all of that has manifested. So, what do we say in terms of the investment stance for UHNIs and HNIs? Maintain some dry powder, but deploy wholeheartedly, because either which way there is going to be reset within the next 2 to 3 weeks, either military or diplomatic. If it is a reset, then bulk of the damage has already got priced in, but we should be mindful of what we are creating by way of a portfolio. So in that regard, we should prefer quality cash flows, low leverage, and businesses which have high pricing power. We should have a tilt slightly on the defensive side, pharma, power, because we have an energy shock and India is very dependent on energy, power, renewables, EVs. These are going to be slightly more favorably placed in the current stance. And what is not so favorably placed is basically on fossil fuels, energy dependent sectors, and rate sensitive cyclicals. These are going to be slightly headwinded. So, I would say that how should we diversify the sources of return? Use geography, that is to say that lean on businesses which are more domestic facing, lean on businesses where there is less conversion into forex, because India is a very poor performing currency on a global basis. If you're importing raw materials, we are headwinded. If we are exporting, then also basically supply chain disruptions could result in elongation of working capital cycle, and so on and so forth. So I think domestic facing sectors tilting more defensive is likely to play out better in the current circumstances than what we had seen prior to February the 28th. And we should actually treat rallies as tactical, and we should actually be positioning our portfolio for the next actually 2 to 3 years, to say the least. Very difficult to predict what is going to happen in the short term, but a lot of pain, as we have seen anecdotally in times of war, has already manifested, is what we believe. So, just to summarize again, next 15 days, we should see heightened escalation, shipping disruption, proxy attacks, energy infra risk, retaliatory strike, and there could be a macro spillover. What is a low probability alternative? And there could be a total reset. Let's say tomorrow there is a diplomatic settlement, and politically they come to agreement, and the Strait of Hormuz is open. Then all of the above, the time transition, the recovery, the reparation happening in the course of the next 1 year, etc., will not play out. then the damage will be recovered very, very quickly. So we have got to figure out whether it's going to be a military settlement or whether it's going to be a political settlement. As things stand today, it doesn't look like to be a very political settlement happening between the warring nations. It looks like more a military settlement that's going to happen. Right? And basically, various parts of the world will have various repercussions. Europe is very disadvantaged because you have very low growth and inflation is going to hit. Asia, also very dependent on energy, is likely to be hit. GCC is going to be a total transformation on the business model that we were used to prior to. It was looked upon as a safe haven, politically insulated, and the sea lines, etc., are very comfortable. All of that has changed. China will have better leverage because they are having a leverage of commodity driven economies. Russia, China, better place because in an inflationary environment, though growth shock is going to be there, but if you are a country producing commodities, you're going to be slightly better placed. And in that backdrop, China and Russia are more better placed than the other parts of the world. Iran, Israel, United States again, this whole AI narrative which was playing out in the first quarter of calendar year 26. And of course, we have seen that anti-AI plays like India were very badly impacted because money flows was happening to economies and countries where there was an AI play because AI was in vogue, so on and so forth. But with very high energy prices, and the basic raw material of any AI initiative or AI infrastructure creation is energy, which suddenly has doubled in price. Maybe, and because the valuations in the US, etc., are 220%, as Warren Buffett says, market cap to GDP, there is no margin of safety, etc. And anti-AI play, if there is a slowdown in the AI initiative, then what has been hammered in India, basically the IT services, etc., could make a comeback. And anti-AI play, which is basically your India, is looked upon as more favorably in terms of capital flows and would see some short-term outperformance vis-a-vis what we have seen so far. So that's how basically I would believe that different parts of the world are likely to see what we had already seen. So India, what is basically going to be the impact? The higher crude is feeding into inflation. We are looking at a situation when inflation is basically going to hit us. It is going to hit all parts of the world, and we have been used to very benign inflation that is changing at the margin. This macro variable is changing at the margin. This basically will manifest itself into government and helping a support, because if your current account deficit is going up, there's fertilizer subsidy that's likely to go up, there's a food subsidy that is likely to go up, and there's an oil subsidy likely to go up. All that, whether it means that this 4.3% fiscal deficit target for the center as articulated in the budget, whether it stays the ground or whether the government is going to relent, because these are not normalized conditions impacting global macros, whether we are going to see an increase in the fiscal deficit number, because beyond $90 Brent, current account deficit will cross 2%. And given that we have relentless outflows from the FI and the FDI front, we are in a twin deficit sort of a issue, which is likely to weigh on the currency and is already weighing on the currency. The challenges will manifest itself into growth assumptions. So gas shortages, constrained tanker movements, freight stress will move the problem from raw materials to working capital to cost of capital. How the policy response is going to be, whether the RBI is going to stay the course as of now or whether they're going to increase rates sometime into the future, is a key monitorable variable that we are likely to see. So it will manifest itself into raw material prices, it will manifest itself into rates, it will manifest into outperforming sectors, underperforming sectors, and portfolio tilt in terms of how the portfolio is resilient given the changed macro conditions. So from an India lens, India in the past has always remained resilient because we are a domestic facing economy, 75% of which is what we produce and consume in-house, 25% is basically export denominated. So within that backdrop, I think higher oil and disrupted logistic pressure will play out over a period of time into FY27 and FY28 earnings expectations, and the policy response from the government is also going to manifest itself into what the earnings growth for the entire corporate India is going to look like. So from a constraint to a shock, this is no longer volatility within the functioning system. It's a system absorbing real supply disruption. So very similar to what happened during the COVID times. First of all, there was a supply shock, there was supply chain disruption that was due to a pandemic. This time around, the supply shock is due to an external manifestation of a war. But there is a supply shock, which was very similar to what we had seen. So it's like that only, and similar positioning as to what we saw during the COVID times is likely to play out this time also in terms of the supply response to the supply chain disruption that we had. So how should we look at the allocation for clients? Don't compromise on quality. Quality will always stand out in bad times better than what the general opinion is in terms of outperformance. No compromise on quality. We should stay liquid, whether in the mid cap or the large cap portfolio. There should be ample diversification, not too concentrated portfolios. Hedges, where we will basically be looking at companies which are less leveraged, because a downturn, if you are very high on leverage, etc., it kills you. And there's allocation of capital, which is very, very prudent by companies. So overweight stance on resilience. We should have our own filter in terms of what is resilient. I would bet on companies which are under leveraged, quality, domestic facing businesses, less reliant on imports, and which companies have pricing power. Which are the vulnerable pockets? These are very high and heavy fuel and trade denominated sectors, something like travel and tourism, geopolitical issues. These are some of the sector, aviation. These are some of the sectors which will basically be slightly headwinded. Discretionary consumption, because first of all, when there is a supply shock, the first order impact is that your inflation is going to hit your consumption. And when inflation hits consumption, is going to hit your discretionary consumption first, rather than staple consumption. And then it will manifest itself into what you can postpone slightly into the future rather than what you can postpone currently. So in that backdrop, staples will be preferred over discretionary, and businesses which have lesser pricing power as opposed to businesses which have better pricing power is where the differentiation in terms of individual stocks in the portfolio is going to manifest itself. So scenario map, in the case of a military settlement, there is going to be a time lapse. Markets are going to be looking at FY28 numbers as opposed to FY27 numbers. FY27, according to us, is a disrupted period, not a normalized sort of a situation. And in this not so normalized sort of a situation where we are looking at an escalation, then there is going to be a compression in the economy and then a selective repair. This is basically in the case of India. We should be slightly on the defensive side and keep accumulating good quality, high growth companies. In the case of a political settlement, everything resets to normal, and we should see a blanket up move in the market, very, very swift recoup of all the losses that we have seen in the market. What is the tail risk? Even after the war ends, there is an energy shock. The way in which logistics of oil moves and the energy transition, because India is so dependent on fossil fuels, 85-90%. What is the transition? These are all going to be slightly more important in the current scheme of things than what it was, let's say, 3 to 5 months back. So what do we have to monitor now? Next 15 days, 2 weeks, Hormuz, Red Sea traffic, oil, LNG freight, INR currency and RBI posture, Asia, the demand stress, how much of demand is getting postponed, destroyed, and what are the repair signals that we are getting from the global and the local macros. Now, how has India behaved in the past in times of war? And this is where we talk about resilience of India. We have basically outlined a situation of 6 war conditions: the Iraq war, which happened in August 90, the Kargil war, which happened in 99, the World Trade Center, September 2001, 26/11 Mumbai attack, November Pulwama 19, and Russia Ukraine 22. We had seen correction of 14, 11, 18, 3, 2, 11, and the outcome of the returns post the ending of the war on a 1 month basis, 3 month basis, 6 month basis is that given the resilience, the correction, the comeback is very, very swift and fast, is what we have seen in times of geopolitical issues getting resolved. Now, whether it's going to be political or whatever, we are looking at the recoupment happening in terms of pulling back of the markets very, very swiftly. And likewise, if history rhymes itself, if not exactly repeat itself, then we should also be looking at this sort of a situation play out whenever this Middle East tension was to wane off. Similarly, if you look at the BSC small cap seasonality, again, one of the anecdotes that in the past we have seen that generally, Diwali time, the broader markets broadly peaks. And around the year end, fiscal year end, you may call it tax harvesting or whatever, the Jan to March period has more often than not seen correction. And similarly, for this fiscal year also, the period ended Jan to March. Again, it was a red tick. But post that, once we step into a new financial year, we have seen green all along. And this is basically the last 13 years data that we have seen. The pullback in the new year happens very, very swiftly. Similarly, this time around also, we have seen some significant drawdowns that we have seen in the broader markets. Hopefully, if history again rhymes itself, we should see a pullback in the broader markets again come through, as has been seen in the previous years. Now, valuations have now reset to almost COVID levels. Almost COVID levels. You can't basically be banking upon the valuations to correct even further. It can happen because we are looking at an extraordinary situation. Today, it's not the mean case, it's not the base case, it's basically traversing on extremes, bordering towards, one standard deviation away from me. So the Nifty 50, including stocks like Zomato, etc., which are at very high elevated P, the valuation at around 19.9 times. If we were to exclude numbers of Zomato, etc., they could be trading at around 17 times, right? The mid cap index, Nifty P, of course, is 30 times. And the last time around also we saw some similarly very similar to around these levels, from which the valuations actually recovered significantly. And even in the small cap case, from what we had seen previously, it has come down to around 24, 25 times. So another macroeconomic factor is that domestic savings is substituting foreign savings. The amount of liquidation by the foreign investors is significant. I mean, we have seen the maximum outflows that you could have seen from foreigners in any given month this March. We just ended a few days back. They sold more than 1 lakh crores in a single month. Now, I would not really blame them for their point of view, but just look at it this way, that their reporting currency is basically the US dollar. The US dollar returns is what matters to them, and they will gauge every metrics in terms of growth, economy, size, EPS in dollar terms. So the fact is that India's nominal GDP growth in Indian rupee terms in the last 10 to 12 years is around 10%, 6% real and 4% inflation, 10%. In dollar terms, this number comes down to 6%. So 2012-13, India's economy, nominal GDP actual figure in dollar terms was $1.8 trillion. As on 31st of March 2026, when Indian currency of the US dollar hit something like 95 or 95 and a half, this number had come down to $3.5 trillion. So roughly $1.8 trillion going up to $3.6 trillion in roughly 12 years translates into a 6% growth. Now, 6% growth, which means that around 3 to 4% growth, nominal GDP for the foreigners has got shaved off due to depreciation of the currency. So that is the main reason, because they have an option to invest in any part of the globe. The capital is almost fungible. The currency risk, the taxation risk is their point of view in terms of why they are selling in India. So in that backdrop, domestic savings, domestic flows, etc., is strongly substituting the FII outflows that we have seen over a period of time. So FII, FDI flows are all negative. This is to some extent getting mitigated through SIP flows that have been seen all along. Massive flows into domestic by investors is supporting the markets as we speak. And I don't see how the situation is likely to change in the near future unless and until you see the currency getting support from the government, or the rupee hardening, because rupee is definitely undervalued, everything said and done. Even at Brent oil of around 104, 105, these levels of the rupee resemble undervaluation, and they should be pulling back. So in that backdrop, if we were to see a rupee appreciate, it should be very supportive of the markets. And if there's an RBI intervention, it should be quite supportive, because that is what is going to not propel the FIs to sell very, very aggressively like they have done in the month of March. The maximum drawdowns that we have seen, the previous peak that we saw was in October 24, March 26. There is a red tick all across. All major indexes have corrected significantly. Maximum drawdowns that we have seen, small cap was around 25%, mid cap was around 21%, 20.5, and this was around 18, 19%. So returns obviously from 31st, from October 24 to March 26 is negative 22 and a half for the small cap index. For the mid cap index is around 12.9, and for the NSE 500, which is a blend 70% large cap and 30% mid cap, is around 15.3. All major indexes have seen deep cuts. Most of the sectors have not yet recovered. There is no single sector which has basically recovered any significant amount of gains that we have seen in the previous peak in 2024 October. Today, we think that thematically, these are some of the sectors which should be slightly more tailwinded. The pharma sector, the CDMO sectors, which have seen maximum brunt on the downside, should also see a pullback. Powering utilities, because of the AI push, the transmission, distribution, renewable, they should be slightly on the higher side. Defense, because these are opportunities created by the government orders, not so dependent on geopolitical issues. And in any case, the geopolitical situation currently would warrant that defense initiatives will slightly be on outperforming side. IT services in an AI environment, IT services underperforms in an anti-AI environment, which is currently the case because energy prices are very, very high. You could see an IT basically pull back some of the losses that they have given in the last 6 to 9 months. Now, as far as our portfolios are concerned, the golden decade for the third quarter, it was 19.6% earnings growth for the third quarter for our portfolio, and the SMID portfolio, it was 26.4%. The Nifty 500 earnings growth for the third quarter was 9%, and the Nifty small cap 250 earnings growth for the third quarter was 12.9%. So clearly, we are looking at a situation when earnings growth of the portfolio is superior than that of the benchmark. The point is that the valuation from a year ago to currently, it has halved. Valuations a year ago was double of what the valuations today are, which is to say the same amount of profits today are at half the valuations than what the valuations were at around a year ago. That is the only difference. The earnings growth superiority stays within the portfolio. This is a golden decade portfolio. The entire portfolio, it resembles the portfolio earnings growth of 19.6%. This is our SMID portfolio, the total portfolio, which is 26.4%. We look at before the reset, etc., about the global markets, the war situation, and we shall see how the earnings growth plays out. But just before the war situation, at the end of the third quarter, December quarter numbers, we were looking at an EPS growth of around 15.4% in a multi-cap golden decade portfolio, and earnings growth for 26 to 28 was around 19.4%, 19.5%. The trailing 12 months P is around 24 and a half, and the PEG multiple is around 1.3 times. And the current market cap weight of this is around 2,47,503 crores. The small cap portfolio, the earnings growth for 25 to 28 is around 23.8%. The EPS growth, for according to us, at the end of the third quarter and before the beginning of the war, was at around 26.2%. And we are now in the beginning of the fourth quarter, and we shall follow the earnings quarter very, very closely to see how this trajectory changes into the next 2 years. My sense is that there will be some dent in margin, some elongation of working capital, some interest cost increase, etc., due to rates getting reset on the higher side. But we shall again redefine these numbers post the commentaries from corporate India, and we shall see how these numbers look from the next 2 years perspective. As things stand, the PG multiple of this portfolio is 1.1 time. Quality, very little leverage, very structural businesses that we have in the portfolio. And the current market cap weight around this portfolio is around 21,579, broadly 70% small cap and 30% mid cap. We also have a product when I should be talking about the pre-IPO opportunity, because we have made one investment in the AIF7. Idea is to have 35% allocation to the unlisted space. And today the valuation reset has been happening even in this space. Very high quality businesses which used to trade at almost double the valuation just about year and a half ago, or maybe 30-40%, 50% higher than a year and a half ago, is today trading at very reasonable valuations. And we will basically be looking at a path of profitable growth. We should be looking at structural businesses where there is a case for margin expansion and capital efficiency. There is not going to be too much of leverage in those businesses. Management compromise on quality is not going to be there, and there is going to be purposeful use of proceeds. We should stay away from high cash burn companies. There should be a total abstinence from businesses where there is no clear path to profitability. Two deep cyclical businesses which are trend dependent businesses, we should stay away. Overvaluation, we shall stay away. Management quality is circumspect, we should stay away. And narrative driven and hype cycles, commentaries by management is what are red flags for us. We have made just one transaction so far in AIF7. This is called Orbis Financial Corporation Limited, and we have bought it at a rate of around 390 to 400 rupees per share. This is a company which is in the capital market space. They settle trades for institutional clients. Under leveraged, you don't have very risk-free sort of a business, because it's settlement not so dependent, it's dependent on trade volumes, and whether on the buying side or the selling side, valuations are very, very reasonable, at least as far as we understand. On an FY25 basis, they reported 200 crores of PAT. We have bought it at a valuation of around 4,800 crores. And even given the slowdown this financial year, FY26, when they'll be reporting numbers, because they report their numbers once a year, we think that valuations vis-a-vis growth from the next 3 years perspective is perfect. Company should be able to come out with an IPO within the next 2 to 3 years. As we have said that we should be only looking at pre-IPO opportunities, or where there's a path to an IPO within the next 2 to 3 years. That is why we have looked at this company. So yeah, And yeah, this is all that I would have liked to say in this sort of turbulent times. I have just, kept open mindset as to how this whole situation is likely to play out and how the portfolio should be positioned. But net, what I think, given past anecdotes of geopolitical issues, whenever they end, it results in a very sharp rebound. Today, we are in that sort of a situation where we are traversing on extremes in terms of fear. Valuations are now reset at around one standard deviation away from the mean. The pivot on the markets was at around 24,000. Today, we are at 22,500. So clearly under shooting on the pivot or the base case sort of a valuation based on historical 18p multiples, which has got defended by the markets at various points in time of, let's say, Operation Sindoor, etc. And within last 10 to 12 years also in NSE 500, you would have seen 17, 18 peak got defended. So again, yeah, so this is how we are placed. And thank you for your patient listening. And now we can open the floor for any question. Rahul, over to you.
Yes, thank you, sir. I think absolutely insightful. You gave us the macro picture, understanding of the way military reset or diplomatic reset can happen and how it can impact everyone. So I'll just request participants, if you have any questions, just drop in your questions in the Q&A box. I already have some questions, so we'll shoot off right away, sir. Or anyone who wants to, have a look at it, please mention that into your Q&A box, and I will try to ask one of them to Manish sir. So let me just straight away get into the questions. Yeah. There's a question. There's no name about it, but anyway, how about global investments and gold? What's your outlook on that, sir?
One should keep investments of 10 to 15% of one's own assets in gold and silver. Critical minerals are going to be in high demand. They will be bid from a slightly medium to long term point of a view because AI is here to stay. You can elongate the time period, but this technology disruption is on us. And in an AI infra built environment, critical minerals are going to be in high demand, whether germanium, whether silver, whether so on and so forth, they are going to be in demand. So I would believe that precious metals in declines are not something we should totally shun because they have corrected. They should be looked upon as a critical and an important asset class within your portfolio from a point of view of diversification and from the point of view that these are going to be industrial uses of these metals into the future. Allocate 10 to 15%.
Okay. Likely question, I think a follow-up to that would be, the topping up of currently into the SMID PMS portfolio. And a linked question would be that, the segments that you just mentioned, are we looking to add or, into those as an addition to the portfolio in the coming months?
So, SMID is more about bottom up. And yes, what we are looking at in the current situation, first of all, our method of investing is slightly to be taking the risk off the table when it comes to investments. So, how do we mitigate risk? Is good management, we mitigate risk. We buy growth, we mitigate risk. We buy structural businesses, we mitigate risk. We buy zero leverage or very little leverage in our companies in our portfolio, we mitigate risk. So these are some of the variables where we are actually looking at, when you look at the investments out there. Some of the sectors are slightly more headwinded, like real estate. But today, if you look at, of course, it's a cyclical, but the way the valuations, etc., some of these companies have got hammered. If you were to look at, let's 2 to 3 years point of view, even the real estate space, they are being available at some ridiculous valuations, so to speak. So you can play a contrarian because you are not compromising on the quality of the management. You are getting something which is valued at, let's say, 100 rupees is at around 33, 34 rupees, provided you understand that value. So let's say the gross development value of a real estate business over the next 5, 7, 10 years is 100. and you are today getting the present value is 100 over the next 5 7 years. Today you are getting the same companies at 33 35 rupees, so one third the fair valuation. I would say this is a clear case of buying. Or let's say you're getting free cash flow businesses, like Quest Corp. We have a Quest Corp in our portfolio. The free cash flow yield of Quest Corp
Right.
is 15%. 15% free cash flow yield businesses. I just can't figure out. Today they are basically having a 220, 230 crores of reported PAT. If you add the depreciation, etc., working capital changes, the free cash flow for fiscal year 26 is going to be in the vicinity of 350 to 400 crores. And look at the market cap today, 2000 crores or even lesser than that. So some of the
Right.
businesses today available some ridiculous values. Or let's say some of the businesses like pipe companies. Today this whole infrastructure in the Middle East has got destroyed. The oil infrastructure. You require huge pipes going into the next 3 4 years. Some of these companies, Maharashtra Seamless is a giant in oil pipelines, and this company today is available at 6p. The management itself is buying from the market, but market is giving you these sort of opportunity. So yes, you keep a balance of what is in the price. I outlined some of the defensive stance in terms of pharma allocation, or these would stay, and we would tilt into these. But at the same time, these are once in a lifetime sort of an opportunities that come when it comes to these values. I mean, 15 20% free cash flow yield businesses. What are we saying? In good times, we find it so difficult to find businesses with the 3% free cash flow yield. Today, all the IT companies, after the correction, large cap, mid, not all, but some of the large IT companies, let's say an Infosys or HCL Tech, etc., available at 6% free cash flow yield business. Basically, you are pricing in a zero growth. Mind you, services
Mm.
businesses don't fall off a cliff. But today, these sort of opportunities are there. So you've got to be mindful as to what the external situation is looking like and create those opportunities into action.
Thank you, sir. One more question comes in. Outlook on BFSI sector, given corporate governance issue with HDFC, can possibly have a cascading effect on the sector, due to the systematic importance of banks. So what's your outlook on that sector itself?
No, no. See, don't let the jury be out on a very large private sector bank. It does not make sense unless proven guilty, they are innocent. So they are not yet proven guilty. So the benefit of doubt goes to the bank, the RBI, the management. You got to take a call on the growth and the valuation. That's about it. As far as the headwinds into the macro space is concerned, is going to manifest itself also into numbers for the BFSI space. And lending institutions basically have problems on two fronts in difficult situations. One is basically your deposit accretion, because deposits is basically the raw material of banks. So when you have a problem of inflation, when you are not able to save that much more, it will translate into lesser quantum of deposits or higher cost for deposit for the bank. That is one aspect that it's a key monitorable. It's not basically visible for the fourth quarter numbers. Fourth quarter numbers are perfectly fine. We should have to look at this number, a variable, going into fiscal 27 and fiscal 28. Fiscal 27, in case of a military reset, is a washout year, where you got to understand the earnings power of the businesses, the franchise value of the banks, how much of a attraction of deposits can a bank attract in difficult times. That's one. And the second is basically credit cost. So IBC has improved the credit culture for corporates as well as retail. Today we have been in a very benign credit cycle, but difficult times like the COVID, there could be a spike in credit cost, and that's a key monitorable. So these are the two monitorables. But if this political resettlement of the Middle East tensions happen, then everything comes back to normal, and we are not looking at a situation. And it's a very large weight in the index, so it's also going to pull back very, very quickly. Today, because of the external situation, it's likely to manifest itself into higher credit cost or higher cost for deposits, which will pressure net interest margins for lending institutions, whether it is going to be banks, PSU bank, private sector banks, or your NBFC.
Got it. Thank you. One more question comes from Vinodji. How much impact do you see on the earnings growth in this FY? And would it spill also in FY 28?
So FY26, I don't see too much of an earnings impact because fourth quarter is on us. It's the impact of the war is likely to be felt from first quarter onwards. And I think for fiscal 27, this war began on February the 28th. On February the 27th, the consensus opinion was that Nifty 50 earnings growth is going to be 15%, 14 to 15%. Now we are looking at a situation where there's going to be increase in rates because RBI is not going to cut rates because inflation will hit
Correct.
India also. For sure,
Correct.
fertilizer subsidy, food subsidy, oil subsidy, fiscal deficit is going to mean that no rate cuts, at best a rate hold or a rate increase. So that's one. Then raw material cost pressures in terms of margin because metals are expensive, everything is expensive, supply chain, storing costs, all of that is just in time. Sort of a manufacturing is nowhere close to what we are all used to. So margin dent will happen from first quarter onwards. So this 15% consensus opinion on FY27 is likely to see some shaving off of earnings growth for Nifty 50. I think 2% or thereabout should be a base case sort of a scenario. We shall have more clarity when we hear from companies management in the run up to quarterly estimates reported for the fourth quarter and how they see situations translating into the first quarter. And if it's a military reset, forced imposition of US on Iran, then basically we are looking at a extraordinary year of FY27, not a normal year. Markets will look at FY28, and I think early FY27 we should see a normalization of a situation. And this is basically an anecdote of how the situation normalized during the COVID times also. During COVID time,
Correct.
when there was a supply chain shock, how much time did it take for a supply chain to normalize? Generally, a year. We are in the first quarter of FY27, first quarter of FY28 is what we should see a normalized. So I think FY28 numbers not impacted according to us. And this is basically assuming that this war will end in two weeks to 3 weeks to 4 weeks, whatever, not prolongate like the Ukraine-Russia war. Of course, these are all black boxes. These are assumptions. If it elongates as big as the Ukraine-Russia war, then FY20 numbers will also. But today the base case scenario is only FY27 numbers should get impacted to the extent as we see things currently, and FY28 should be a normal year.
Thank you. There's a question by Yogesh ji. In our AF7, how much more IPO opportunities are you looking into evaluating?
We are looking at two more spaces. We are doing our due diligence. One is a battery energy storage company, one is a pharma company. So we are doing our due diligence.
So overall, 25-30%, sir, in the portfolio?
Yeah, we have kept the mandate at 30, maximum 35%. So 30% will be allocated to the unlisted portion for sure.
Unlisted service. Question, Ramanji, about sector, you think it's a good time to allocate more?
100%. If deployed in tranches, I would not say go all in, but do it wholeheartedly. If you have 100 rupees, at least have the willingness to deploy 50 rupees. It always looks that yes, you could have a better, but as they say, the timing is very difficult. But you can broadly say that the markets are traversing on extreme fear. You don't know exactly when, but as I said, the base case values on Nifty 50 should have been 24,000. Today we are at 22,500. So we are obviously below 24,000. And this is deviation away from the mean on the negative side. So keep some dry powder, but do allocate.
Noted. One more question comes in. Mentions about very well explained about the details. When would you think FIS can return to Indian market?
Don't assume they will come back. See, the whole point is we are used to saying that India's economy doubles in 6 to 7 years. But for them, India's economy in dollar terms is doubling in 12 years. And if you assume that the rate of inflation is 2 to 3% in dollar terms for them, then you are basically looking at a 3% real GDP growth country. Why should they be
Hmm.
bothered with such high capital gains taxes, STT, and then looking at a massively rapidly depreciating currency? Why should they take the risk? So don't build on FI flows. What is silently happening is that domestic savings, SIP flows are domestic pool of savings of Indians getting shifted to foreign savings. The total FII ownership is getting substituted. At one point in time in the past, FIIs owned 22% of India. Today they own something like 15%. I would not be surprised that in spite of good, bad, ugly, because you are looking at a dollar returns which is subpar for them, they'll be tempted to exit India. Let them exit. That does not differentiate anything. After all, the values are fundamentally driven. So now for a rupee investor, for Indians, what is important is 10% rupee GDP growth, nominal. Within that backdrop, what is the valuation? Of course, the war risk premium, equity risk premium has gone up for both Indians as well as foreigners. So, to price in equity risk higher than what you had in terms of cost of capital when you do your DCF is what you should build in. But markets have already corrected. We are already trading a Nifty 50 at 17, 18 times. That's ridiculous valuation. Don't build on FIs, but some of the important metrics in the case of India is basically market cap to GDP of 125%. Now, 125% means that listed entities market cap is 125%. You are building in, let's say, a 10 to 12% sort of a growth. Now, whether that market cap to GDP of 125% is good or whether it can correct further, that is a call that you need to take. I think the valuations have come down from 150, 160% to 125%. The IPO market has cooled off very, very substantially. These are steps in the right direction. But I would not bank on the FII flows to come back. Very difficult to say, and you should take it as a bonus if they consider it India investable. I think the only silver lining is anti-AI play. India will stand up because India was deficient in terms of flows when AI narrative was very, very strong. Money flows went into AI-driven economies of Korea and Taiwan and China, and India lost out a lot on the pool. Now, if it is an anti-AI play because of energy shock, then India should get a benefit, but that's about it. Don't build too much of cushion coming in from FIs. One more thing is that for us, India, foreign capital is important. Without foreign capital, FDI plus FI, India can't expect to grow at 8 9%. That's not doable. Our base case growth, in case we have a continuous selling of FIs in terms of economic output GDP, should not be more than 6.5%. That's the best case scenario. Provided we have an ICOR, which is incremental capital output ratio, efficiency of around 4, 4.5. There is no leakage in the savings, so on and so forth. But yeah, that's how the situation is as of now.
Thank you, sir. So you view on copper considering AI and industrial use in the near future.
The copper is deficient and particularly so supply chain. There is a whole amount of copper that is sitting in the United States, but different parts of the world are deficient. So there is a supply chain disruption that is happening. It's a critical mineral that is going to be required in the AI setup. Of course, you can say that optic fiber is going to be more efficient, but copper will be required. Whether cables or power or renewables, transmission, copper is an important mineral to be looked upon. into the future as well. So I would basically be bullish on copper and aluminum on the commodities, metal space.
Got it. Uh, if INR appreciates, then what impact comes on PMSs as simultaneously bond yields are also spiking and reset is on the way. With the looming threat of recession and loss in fights, I don't know, how do you allocate going forward if that happens?
Now, come again, there was a breakage in the
Yeah,
voice.
so I said INR, the question is if INR appreciates, then what impact comes on PMS? As simultaneously bond yields are also spiking and reset is on the way.
No, so basically bond markets are very efficient. As I said, that either rates in India is going to be status quo or they will be an increase in rates if the rate hike by RBI happens. So currently bond markets are basically telling you that inflation is coming back. A slight bit of inflation is going to be positive for India. And let me tell you, if you have an expansion in fiscal deficit, that is always good for growth. Expansion of fiscal deficit is good for corporate profit growth. Slight increase in inflation, slight increase in rates is good, not too much. So within that backdrop, you have to figure out the companies which you are owning. So some of the spaces that I alluded to is domestic facing businesses which are positively impacted by inflation, let's say commodities or defense and transmission, power. These are going to be favorable. What is basically going to be slightly headwinded? Real estate, travel and tourism. These are some things which you have a propensity to postpone when you have lesser saving because of an inflationary reset. Your consumption will come down because your income doesn't go up in a hurry in the short period, and that is why your portfolio tilt will determine what you buy and not buy. That is how the PMS's returns are going to get impacted.
Do you still foresee further correction from here? I mean, of course, if no one can mention that, but do you still foresee that?
No. As I said, that we are already traversing on extremes. If it goes down further from here, value becomes deep value becomes deeper value, and deeper value becomes deeper value. That is all that I can say. There is already value in the market, but you have to give it some time, 2 3 years if you can give, and don't look at the stock prices on a daily basis. There is ample value in the market.
No, sir. If we see a rate hike, how much does it impact the real estate index?
It's already corrected. As I said, today all the real estate stocks have fallen by more than 50%. So, is there value? I have never seen that. This is a cyclical business. Cyclical business. If you buy it at a very steep discount to NAV, you are fine. I think you should be good enough to calculate how the launches are going to be. What sort of a annuity business does these real estate business annuity businesses mean? How much is the rental component in the real estate company that you are looking at? What is the pre-sales? I will look at real estate companies where pre-sales growth is at least 20%. So all the branded companies in the real estate will be better off than unbranded real estate companies because they are in a better position to launch their new products. And companies, these branded companies, if they have a rental income portfolio, then they should be better placed as opposed to those who don't have a rental income on an annualized basis. And on an overall basis, the real estate index per se has corrected significantly.
Thank you,
There
sir.
is value. There is value. You have to think 3 4 5 years.
Yeah.
Similarly, for co-working space. Co-working space is also today hammered because of AI and GCC and all that. Today, these are also trading at some ridiculous values. And so are the hotels. So you have to think contrast slightly.
Basically, we have to think about next 2 to 3 years and not really 6 months.
These are fabulous businesses. Let me tell you, if you were to return to a normalized situation in FY28, some of these sectors are very good businesses because supply cannot increase suddenly. Today, this is an extraordinary situation where there's logistics and postponement of travel, etc. But this is like your COVID. You all sitting at home. some of these spaces got hit very bad. When it opened, it just flew through the roof. Similarly, it's going to happen.
Uh, so you think DIs do have, the support level to hold the way kind of, FIs are selling off? I mean, till how long this can continue?
Till the time you have 25,000 crores of SIP come through and you have a very docile, benign IPO market, don't have the P exits gunning for exits like you saw September to December 25. The amount, the flurry of IPOs, two major problems on the Indian stock market is flurry of IPOs and the retail jumping on listing gains. That is one, and the second is basically your SIP flow. I am given to understand that this month, the closures of SIP is going to be of old investors slightly going to be higher than the normal. So if you are used to seeing 25 to 30, maybe this time around you'll see 20 to 25. But as long as it is between 20 to 25, it should be okay. We are already seeing all that reset of SIPs, etc., manifest itself in terms of valuation and prices. So FIs will keep on selling. It does not really matter who is buying, who is selling. It is at what price you are buying or selling that matters. It is about tol mol ke both. Color of money is the same. 17,000 crores buying by a DI has equivalent value as to a 15,000 sell by an FI. 17,000 buying by DI today is disproportionate, as if the color of money for the DI is lower than the color of money of the selling by the FI. It does not happen that way. Ultimately, it has to be weighed in mathematically. So I think one can see the glass half full because FIs are king and DIs are not so king. But I would disagree with that. Today, I would believe that the DIs are much smarter than the FIs if they are buying at these prices rather than selling at these prices.
Thank you. So two segments. One is media stocks to a large extent. Do you feel with the correction it's a super value buy? And second, our portfolios also have some capital market entities. So what's your outlook on those segments in the market?
So we have one media company, Tips Music, because ROEs are in excess of 100% for them. They have no capital consumption. It's literally a company which is running on 15 to 20% growth with zero capital consumption and 70% dividend payout ratio. Monopoly sort of a situation, two only companies. Except for that, I think very difficult to figure out media businesses except for maybe, let's say, a Sun TV, which again is trading at some ridiculous valuation. We don't have Sun TV, but clearly it is one of the names to be looked into. We will look into it as well. But other than that, no. And what was the other question?
So capital market
Capital
entities.
market. Look, distribution businesses are very good businesses. They are very unglamorous. And that is why they make so much of money. The wealth managers, the distributors, I mean, people say, अरे क्या है distribution में? बहुत unglamorous लगता है. These retailing companies, etc. पर पैसा वही बनाता है. ये सब intermediation businesses are high quality business. इनमें they are very high ROIC businesses. A Nuvama or a JM or JM is over capitalized. JM makes a profit of 1,500 crores per year, but they have a capital of 10,000 crores. They don't require capital of 10,000 crores in their business. They require probably only 5,000 crores in their business. So, their leverage on the lending book is just one. So that gives you the margin of safety, not the extra, because the reported ROEs are 9%. So it should trade at below book. Why should it trade at below book? He's unleveraged, he's under risk. So that is how to look at it. Or let's say a grow, which is real monopoly in terms of new age businesses, growing even at 25%, even for the March quarter, the reported numbers in terms of market share, new client addition, ARPUs, distribution. I would believe capital markets are slightly de-risked in this risk environment, because buying or selling, your AUM goes down, but the whole thing is that you have new SIP flows that is coming, plus the AUM markdown, translating into net AUM on which you charge fees. So I would believe these are very high quality businesses. If you are available, if they available at lower prices, all the more reason to go out and buy.
Noted, sir. Question from Abhishek. Consumption sector has been in a slump for a while. Fundamentals, although look decent, but valuations possibly remain expensive. What's your outlook on this sector now?
Every consumption stock has underperformed. And basically, the whole problem is middle class is not seeing an increase in income. And today, again, this whole reset of high inflation, translating into lower volume growth and higher value growth will manifest itself. I think the way to look at consumption stocks is where there is pricing power or which are dopamine addictive consumption areas. Alcohol, cigarettes. I mean, it does not matter whether it is high price, lower price. Valuations in any case for entire pack has come down. But these are dopamine addicted sectors. You're addicted to dopamine and you will actually consume them. They have high pricing power. Transfer of pricing happens. These are some of the better placed. But other than that, consumption stocks, typically a zero growth consumption stock will trade at anywhere between 20 and 25p. If the earnings power or the franchise value of that consumption stock stays intact and valuations have come down to 2025, there is value. It's only a matter of time. So I would always be more favorably placed for discretionary consumption as opposed to staples consumption. But in current environment, it is necessary consumption which is going to take prevalence over discretionary consumption. Staples will take prevalence,
Okay.
but here I would prefer more discretionary, and within the discretionary companies which are catering to your requirements of dopamine first, and companies which have better pricing power, and third is valuation comfort. If it is zero growth priced in at 20 to 25p, provided there is franchise value, there is earnings power, I will go out and buy.
Which sector provides maybe a multi-bagger kind of returns in the next maybe 2 to 3 years kind of scenario?
Bazaar has corrected so much. There is value across the sector. I mean, आपको जिस सेक्टर में फेथ हो वहां पर है स्टॉक लेने के सब मल्टीबैगर बहुत मल्टीबैगर है.
Okay. I think we don't have any more questions. Uh, wait, um,
Rahul, your voice is breaking.
I said, sir, no more questions as of now. I just made for a minute and then I'll close up.
Sure.
Just one more coming in. What is your opinion on US and China?
They are fighting, and China is so massively industrialized, and because they are a export denominated economy, and because of fighting between US and China, imposition of tariffs, etc., they are left with a lot of surplus capacity in the system. So China is going to dump this excess capacity, which they cannot produce and send to the US, to all parts of the world. And India has to protect itself through protection by way of anti-dumping duties or ALMM. So non-tariff barriers or tariff barriers by anti-dumping duty, or let's say this BIS certification, these are non-tariff barriers. India has to protect itself because today WTO has no sanctity. WTO is dead. WTO को कोई नहीं सुनता है. You can't complain to WTO and get a solution. So that is where the vulnerability of India comes through, that protect yourself from dumping by China. And China is oversupplied, overcapacitized in almost all industries currently.
Noted, sir. Yep. So I think uh, this question is already answered. Well, small question. Should we invest in both countries? अगर US and China की बात करें तो?
US is very vulnerable. वो वॉरेन बफे का आप CNBC का इंटरव्यू देख लो. It is an eye opener. मतलब literally this man thinks so rationally. Well, वहां पर the growth in the US is coming on the back of AI and all of that, massive capacity expansion and all. There's a CNBC interview by Warren Buffett because he's sitting on some $370 billion of cash. And the reason the reporter asked him is, why are you sitting on so much of cash? He says the market cap to GDP of US is today 220%. Of course, this is predicated on growth in AI. But for AI to happen, you require energy, or let's say oil, because you burn methane. 75% of US energy is through methane, burning of methane. And this methane suddenly has doubled in price over the last 6 weeks. So, in that sort of an environment, whether the growth projections of some of the companies in the US will still hold. So, I would believe that US is very vulnerable in terms of valuation and the thematic AI narrative that is being floating all around out here.
Um, any long-term view on precious metals? Why are we
Positive, positive.
considering?
I mean, see, gold has given you 9% returns in INR terms over long periods of time. We are not talking about the last 1 year, 2 year, but look at 10, 15, 20 years. Anything said and done, CAGR returns has been 9%. I think as a matter of diversification to the extent of 10 to 15%, just look at this 9, 10% as that only. So gold and silver, you should build in a 10% sort of a return, but it saves you on a rainy day. And there's good diversification. So long-term outlook is positive as a matter of fact from the point of view of diversification and from the point of view of critical minerals, which is going to be required into the future, of which some of the precious metals are a part.
Noted, sir. Scenario in the event of China taking over Taiwan, assuming post-war when the dust settles, would it change any scenario for us? Because they are also looking at Taiwan takeover and all.
See, Taiwan is obviously for semiconductors, and semiconductors is their monopoly.
Mhm.
So I would look at it this way, that in the Indian ecosystem, you know, this is again going to be a shift of power more in the hands of China from the point of view of semiconductor prices. So today, what is happening is that 50% of AI infra cost is chips, 30% is RAM. Now we don't have anything of this 50 and 30 in house. So for chips, semiconductors, China will have bigger leverage in case they occupy Taiwan. Prices are going to shoot up. Like RAM prices, because Hynix and Samsung, they are global monopolies in case of RAM, random access memory. The prices, I'm given to understand South Korea's earnings growth this year is 150% or 130%. South Korea is growing at 130 or 140% because 40% of the index out there is made up of three companies which are manufacturing random access memory. So a bigger leverage will play out in terms of global prices of some of these stuff if there was an invasion of Taiwan, because they are masters in semiconductors.
Got it. So I think we can stop here. So I think all the questions were answered. I would, thank you, Manish sir, for this very insightful and confidence building session, which is I was very much required at this point of time. And I would say participants in the current market environment like this, it's basically helps us a lot of clarity and reinforce ourselves to look at the long-term version of conviction on equity markets. And I'm sure all of you, as a client, as our partners, found this extremely valuable. And thank you everyone for joining us and for the continued trust in MK Investment Managers. Have a happy evening. Thank you very much. Thank you, Manish sir,
Thank
again.
you. Thank you, folks. Thanks for your time. Thanks for your
Thank
patience
you.
listening. Have a great day. Bye.
Yeah.